Hello, Hinge friends. Hope everyone's doing well. Really good to see everyone here today. Big interest in this subject of tax strategies. If there's one thing that I hear repeatedly from our event guests or contacts that we have in the industry, it is, where can I go for creative strategy around taxes? I'm so frustrated with not having a strategist who can help me put things in motion for my future. And I'm so excited about our guest today, who is my personal tax strategist and someone who I have known and worked with for so many years, 43-ish. I don't mind saying that at all, because it's been a great ride. So super excited today again to introduce my very good friend Melissa Bane. Melissa, thank you so much for your time and being here. You guys might know Melissa also from Shift. We drag her onto the Shift stage anytime that we can, because her information about financial concepts is something that I personally couldn't live without, and I know that she's contributed a lot to you guys. So Melissa, thank you for being here. I'd love for you to tell our guests a little bit about yourself and your background.
Well, thank you for that. Thank you for having me here today. So I have spent my entire career in the financial services industry. Just on the personal side, I was raised by a single mom in the mid-60s. That was a difficult time for women. The job opportunities were not that great. Especially for someone who only had a high school education. And so I grew up really watching my mom struggle to make ends meet and to really keep a roof over our heads and food on the table. And as you could imagine, that made a big impression on me and my career choice. And so after college, which I worked in a cotton mill and put myself through college. And after that, started a job with Elliott Davis in public accounting. And from there, I went to work with a worldwide manufacturing and sales company as their director of finance. But I really missed the opportunity to come alongside people individually and help them just improve their financial situation and meet their financial goals and objectives. And so I became a part of Greenwood Capital. And here at Greenwood Capital, I'm a senior private client advisor, and we focus very heavily on holistic and comprehensive financial planning to help our clients meet their financial goals, and also to just keep as much of their hard-earned dollars in their pocket as possible.
I love that. You guys, if anyone in my family asks me anything about my financial situation, I just write down Melissa's number. That's all we need to know. There's certain things you need to outsource, and I am a financial person, but I don't pretend to dabble in the world that Melissa does. And when she says she takes a holistic approach, I mean, she knows my will, my insurance, you name it. If it has a financial impact, she knows about it. So I greatly appreciate Melissa. To kick off Melissa's presentation, we have a couple of polls. We'd like to kind of see where you guys are coming from and collect a little bit of information. So you should see go to poll pop up on the right. What we would like to know is, do you guys feel like you have a tax efficient exit strategy in place? So this is something I'm working on right now. So if I had to answer this question, I would have to say no. I would have, again, as a person who coaches people on what their businesses should do financially, and a financial person, I'm just working toward a tax efficient exit strategy. We might all know what our exit strategies are, but what are the tax efficient ways to do that? What, Melissa, how does this speak to you? It sounds like about 4-to-1,
Yeah.
3-to-1 no's to yeses.
So I work with a lot of business owners, and an exit strategy of any kind is scarce, to be honest with you, because the business is sort of your brainchild, your baby. You've just devoted everything to it. And I find, at least with the business owners I work with, it's hard to change that gear and even begin to think about any sort of exit strategy, much less has someone sat down with you to figure out some tax efficient ways of exiting that business. And again, passing as much value on as possible to whomever, if it's family or otherwise, as well as keeping as much of that value that you built up over the years in your pocket to work for you and your future generations.
Yeah, really good point. I have to tell you guys too that one of the things I love about Melissa is that I can ask her the same question a million times and she never makes me feel stupid. So that's always appreciated. Thanks for that, Melissa. So let's go to poll number 2 and see what we have in the second one. Do you meet annually with your professional team, including your certified financial planner, CPA, and attorney? I definitely do meet with my certified financial planner. You're looking at her, and CPA. I'm not so great with the attorney. And I can't tell you what a blessing that is. And I don't instigate that. These guys instigate it for me. So look at you guys. This is fantastic. So it's interesting, Melissa, that the majority of people now do have that meeting, but aren't quite as confident that they have a tax efficient exit strategy in place. Maybe that's the trigger.
Yeah. So, this is an important question because I think we're all pretty aware that there is a shortage of CPAs right now. I know in South Carolina, they're having a lot of difficulty getting college kids to be interested in taking this route. And so most of the CPAs that I know and work with, it's just about all they can do to get their work done and get it out the door. It's hard for them to find the time to be proactive with their clients and do planning ahead. And attorneys, sort of the same situation. I don't know that there's a shortage of attorneys, but to get the proactive planning in place, it's more if you know what you want and need and ask for it, you can get it. And most of the attorneys and CPAs that I work with on my clients' teams welcome the CFP side coming in and kind of keeping things on track and keeping things pushed forward. And frankly, I don't try to do the work of the CPA or the attorney, but just raise those questions that I think need to be answered to help put the client in the best position.
Melissa, for people who don't do that combination meeting, would you suggest they start with their CPA and then invite their financial planner in, or the other way around? Does it matter? What might be a good place to start?
If you're working with a CFP, I would probably start there because I think it just lines up with their job duty. And then pull in the CPA. And then I think because of the expense associated with working with an attorney, when you get to the point to where you kind of have a plan that high level that you know what you want, then pull the attorney in and put that plan in place.
Okay. It wouldn't have been anything I would have ever known was a possibility until you introduced it to me. So I'd love for other people maybe to think a little bit broader about the collaboration between that group of advisors. Okay, let's move on to the next poll. 2 more. Do you have adequate liquid operating capital for 6 to 12 months? Yes or no? While we're weighing in on this, I'll tell you guys my story that I think traditionally the world would say you need 6 months of liquid operating capital in case something happens. But what the world did not see happen was 2009 and 10 economic downturn for this girl, because that meant that we closed 0 transactions in 2 years. So instead of 6 months, I had to be prepared for 2 years. A lot of our guests here have survived their way through COVID and various cycles in economic factors, and I'm just really thrilled that at least half of our guests here feel adequately protected. How does that stack up with what you usually hear?
I think that's pretty accurate, actually. Pretty much what we see. I mean, some folks tend toward the more conservative side, and so they're going to make sure they've got that operating capital. And then, on the other hand, you have folks that, things are going well, and we just don't think about that rainy day that can come along, that could really put you in a tough situation if you don't have the cash to keep the business going during a downturn. And we do get spoiled because we have, these extended periods where things are going well, and we kind of forget that 2007 to 2009 period or the COVID period. We tend to forget the negative things a little more quickly. Yeah,
we do. I know. And also, if you're in a growth mode, if you guys are feeling that like I am, I've really geared my team up because there's so much activity. And in a growth mode, you tend to layer in the expenses. Expenses go up. Your EBITDA goes down, and then you have to wait for that activity to hit. So there are various reasons why it might be difficult to manage your cash the way you want to. And then our last poll, are you fully utilizing tax advantaged accounts such as 401k, HSA? I can't remember that one for anything. Or cash balance plans. So Melissa keeps me on track with 401k and cash balance plans. I'm terrible. She tries to keep me on track with HSA, but those are some of the tax advantage plans that should you speak about those now, Melissa, or are they in your material coming up?
Yeah, they are in my material coming up, but I'm interested to see these results. Here again, this is about keeping as much of your hard-earned money in your pocket as you can and reducing that tax bill. And it just gets away from you because, the amounts that you can contribute to these change every year. And if someone's not sort of nudging you along, it does get away from you. And so we're going to be talking about really 3 strategies today for keeping tax money in your pocket, and cash balance plan will be one of those strategies.
Beautiful. So I am going to turn the presentation over to Melissa so you guys can focus on her. Please, again, I see Carrie has already contributed a question. Thank you for that, Carrie. I'll monitor the questions. We'll come back with about 10 or 15 minutes left and tackle your questions. So don't hesitate on that. And Melissa, I'll see you in a bit. Thank you.
All right. Thanks, Kathy, for getting us going. So I do appreciate everyone being here today. We're going to move rather quickly because I do want to leave time at the end to get to everyone's questions and comments. Meredith is going to help me with the advancing of the slides. So if we could go ahead and move to that next slide, I just want to talk a little bit about why I think this is so important for business owners and why I do so much focused work on business owners. Mainly because, the priority has to be on running the business, keeping the doors open, keeping the employees paid, and that sort of thing. It's hard to proactively think about your own personal situation. For many business owners, everything is just reinvested back into that business, and they don't have enough liquid assets because they're not really thinking about that rainy day. And we took the poll questions. So obviously we know that a lot of business owners don't have a tax efficient strategy in place. Honestly, the majority of business owners I work with don't want to talk. It's kind of like planning, for wills and powers of attorney and planning for death. They don't want to plan for exit strategy because they don't want to face ever having to leave that business. And lastly, one of the issues I see working with business owners is it's difficult to turn control over to other professionals. But to Kathy's point, we talk about all the time when she and her CPA and I sit down, it takes all of us to keep things on track and moving forward and fully taking advantage of all the opportunities that we have available. So on the next slide, we'll breeze quickly past it. That's just our disclaimers. Obviously, here today, I'm giving high-level information, not individual advice for anyone in particular. Then on the next slide, one of the strategies that I want to talk about has to do with real estate investments, and it's 1031 exchanges. I'm not sure how many of you own your properties, but in doing some conferences at Shift, it seems that many of the attendees there do own their real estate. So a 1031 exchange is an excellent way to sell and replace real estate without paying capital gains on that. It's an IRS approved transaction that allows you to defer and in some cases completely eliminate the tax on the proceeds from the sale of a business. So I think the easiest way to demonstrate how these transactions work is to look at an example. So on the next slide, we're going to meet Sue. Sue is a child care center owner who purchased a center for $2.1 million in 2011. Now, she's outgrown that facility and she needs a larger complex. And so if we move to the next slide, we'll see that her basis in her current building, she purchased that building for $2.1 million. And of course, she had some acquisition costs. She made some improvements to the building along the way. On the other hand, she also took some depreciation. So her basis in that building is $1,760,000. Now, if we look at what would happen in a sale of that business, say she sells, not the business, but the building, she sells that building for $3,250,000, and we subtract her basis from that, she's going to have a realized gain from the sale, if she does an outright sale of that building, of $1,490,000. So let's look at how that gain would be taxed on the next slide. In an outright sale, Sue is actually going to be handing over to the IRS about $380,000 of her equity in taxes. And if we move ahead, we can see where that tax number is coming from. First of all, she is going to have to pay long-term capital gains on the capital gain portion of that sale. She's going to have depreciation recapture tax on the amount of depreciation that she had taken over the years that she owned the building. And because the numbers are so high, this is going to throw her into a net investment income tax situation. So she's also going to be subject to that additional net investment income tax. So it's right at $380,000. Now, if she had done a 1031 exchange, as we see here, she could have avoided all of those taxes by exchanging this building for another building. So let's look now at another example. In Sue's example, she was staying in the business and she wanted to continue to own real estate. So an exchange made a lot of sense. Let's meet Howard and Ann. Now, in 1992, they purchased an apartment building for $850,000. Today, that building is worth $3.2 million. So if they were to sell that building, we'd have the sales price of $3.2 million. Of course, there's always going to be selling costs when we sell a property. So they are receiving a net sales price of $3,008,000. We have to, from that, subtract the original basis. In this situation, the building was fully depreciated because they had owned it for so long. So they have a taxable gain from the sale of $2,158,000. Now, considering capital gains taxes and net investment tax, that amounts to $513,600 plus depreciation recapture of another $212,500. So in this situation, Howard and Ann are losing $726,000 of their equity. But let's assume that they want the income stream and they don't really want to be out of the real estate business, but they just don't want the hassle of actively managing that property. So what are their choices? If we look ahead, maybe instead of selling that property, they make a 1031 exchange into 3 different Delaware statutory trust properties. So what types of properties could that include? Well, it could include an apartment complex where they just own a fractional share. They could purchase a fractional share of some storage units. And they could also purchase a share of an office building. So they have invested their total proceeds from the sale of the building into 3 different properties. Now, what kind of goals do they achieve when they do that? Well, let's take a look, because they've achieved quite a few goals in doing that. First of all, they have preserved all of their equity for reinvestment. They have paid nothing in taxes. Secondly, rather than only owning one type of real estate property, they have diversified their real estate portfolio into 3 different properties. They have deferred all the taxes that they would have incurred. They have eliminated all of their active management responsibilities. They still have established a stable retirement income stream, and they have restarted the depreciation clock on these 3 properties that they just purchased shares in. So if we move forward, I just want to talk about a few of the basics of 1031 exchanges, because we can see how very valuable these can be. I recently spoke at a conference and someone came up to me after the conference and said, I wish I'd heard you 6 months ago, because this is exactly what I did, was sell one facility and purchase a larger one. And I think she had lost about $500,000 in taxes. So there's only a few basic rules regarding 1031 exchanges. First of all, the replacement property purchased must be of equal or greater value than the property being sold. All the proceeds from the sale of the original property must be relinquished, must be used for the purchase of the new property. And it has to be a like kind property. We're going to get into a little bit more of the explanations on that in just a minute. So let's move to the next slide. There's basically only 5 rules concerning a 1031 exchange for it to qualify. First of all, the exchange must be set up before the sale of the original building closes. Second, the property owner, if you receive above and beyond what you're going to reinvest in the new property, you will have to pay taxes on what's considered the boot, the above and beyond amount. It must be the same taxpayer who sells one property and acquires the new property. There's a 45-day rule. So from the sale of the first property, you have 45 days to identify the replacement property. And then the property owner has 180 days following the closure of the sale on the original property to complete that exchange into the new property. So if we look at sort of a little graph about how that process looks. So first of all, determine whether a 1031 exchange makes sense for you. And we're going to look at something in just a few minutes that kind of identifies those folks that it would make sense to use a 1031 exchange. Step 2, you put your current property on the market, you enter into a contract to sell that property. Step 3, you're going to find a qualified intermediary. Generally, this is an attorney who is just simply going to hold those funds from the sale of the first property until you identify and close on the second property. Once you close on that first property, you've got 45 days to find a replacement property. Then you have the 180 days to close on the purchase of the new property. And then after everything is complete, make sure that you notify your tax advisor of the transaction. So 1031 exchanges, we saw, can save significant tax dollars. For Sue, it was almost $400,000, and for Ann and Howard, it was close to $800,000. So how much do 1031 exchanges cost? Well, it is extremely minimal when compared to the taxes that you save. The primary cost is that fee that the attorney or whomever, could be a bank, could be a trust department, but normally I see attorneys, is the cost that they charge you for holding the proceeds in escrow until the entire transaction is complete. So let's look forward about who should consider a 1031 exchange. Well, if you are planning to sell one investment real estate, but you want to continue investing in real estate, this would make sense for you. If you have fully depreciated real estate and you want to restart the depreciation clock, this could make sense for you. As in Howard and Ann's situation, if you want to continue to hold real estate and enjoy that income stream, but you're tired of active management, this could make a lot of sense for you. If you're in a partnership and someone in your membership wants to cash out their investment, but you want to stay in, you might want to consider this. And then again, just like Howard and Ann, if you want to diversify the different types of real estate holdings that you have, this should be something you might want to consider. I put together a few frequently asked questions about 1031 exchanges. So what type of property is not allowed? Say you find this very interesting. What kind of property can you not do a 1031 exchange for and avoid the taxes? Well, you can't use this strategy for your primary residence, for the sale of that, and you can't use this type of strategy for personal assets, personal property, such as jewelry or art. Can you do a 1031 exchange with a related party? Son, daughter, sibling? Yes, you actually can. How is the gain on a 1031 property taxed at death? This is one of the real beauties of the 1031 exchange transaction. If you are holding a property that you acquired through a 1031 exchange at your death, then at your death, you will get a step up in basis of that property. And at that point, if your heirs sell that property, in fact, no one will ever pay that capital gains tax. So in that situation, not only have you deferred the tax, you have completely eliminated that tax. Can you move into a property that you acquired through a 1031 exchange? I think this is another excellent planning tip. I have quite a few clients that own vacation homes, properties at the beach or in the mountains. So yes, you can move into a property that you acquired through a 1031 exchange. But if you do that, you would want to first rent that property out for a minimum of 2 years. Because what you'll need to demonstrate to the IRS is that when you acquired that property through the 1031 exchange, your intention was to hold it as an investment property. After that 2-year period, you can move into that property and use it as your personal residence if you want. And if you do happen to move into that property and make that your personal residence, and live in the property for 5 years, you could then sell that home down the road and take the $500,000 primary residence exclusion from the gain of that sale. Can you 1031 exchange into a REIT? I get this question a lot. And no, you cannot 1031 exchange into a REIT. Let's look at our next tax strategy for saving tax dollars, and that is a deferred sales trust. Now, a deferred sales trust is just basically a legal contract between an investor and a third-party trust in which the investor transfers that property into the trust in exchange for a promissory note that's paid over some number of years. So let's look and see how this works. We're going to meet Kay. And say Kay owns an office building with an adjusted basis of $100,000. Today it's valued at $500,000. Now, if Kay just sells that building outright, she's got a realized gain of $400,000, which is probably going to cost her about $125,000 in taxes. Now, if she were to instead transfer that property into a deferred sales trust, let's look and see how that would be taxed. So she transfers this property into the trust, and there'll be a gross profit percentage calculated. So her gross profit on the sale of this building was $400,000. $400,000 divided by $500,000, there's an 80% gross profit percentage. What that means is every dollar that she receives in an installment payment, 80% of that is considered profit. Now, Kay decides that she wants a 5-year promissory note. So this is going to stretch the $500,000 proceeds out over 5 years. So she's going to receive a payment of $100,000 each year. And she is going to pay 15% capital gains tax on the annual profit realized. So if we look at the capital gains tax calculation, the $100,000 that she receives each year, 80% of it is profit. 80,000 times a 15% capital gains tax rate is $12,000. So she's going to wind up paying $12,000 a year in taxes. Over 5 years, that's $60,000 versus the $125,000 that she would have paid in an outright sale. So let's look on the next slide and let's see what goals did Kay achieve by doing this. Well, first of all, she spread her tax burden out over 5 years. Spreading that gain could completely eliminate the net investment income tax because she's not going to have that big lump sum coming in 1 year. It could also reduce the amount of her social, if she is in a position where she's getting Social Security income, it could reduce the amount of her Social Security income that is subject to tax. And because Medicare premiums now are based on your prior 2 years' income, that could help keep her in a lower bracket for her Medicare premiums. Also, you could say, well, why doesn't she just owner finance? Well, if she owner finances, she's accepting all of the risk from that buyer defaulting on that loan. In a deferred sales trust, there are no timeline rules like you have in a 1031 exchange. You don't have new property that you have to identify. And for this strategy, it can be used for any type of asset, not just real estate. So there's, a few basics related to deferred sales trusts. Number one, the third party, the deferred sales trust is the third party in your transaction. You're going to receive payments over time, and you're going to delay or completely avoid any realized capital gains, which is going to keep your taxes lower. Now, I know I've thrown a lot at you. There's only a couple of rules when it comes to deferred sales trusts. The trust must be managed by an unrelated third party. So it cannot be a family member. Normally, again, it's a trust department or an attorney's office can help you with this. And the seller cannot at any point in the transaction take receipt of those proceeds. Those proceeds from the sale have to be deposited directly into the trust. So let's skip over this next slide just because I feel like it's a little redundant, and I really want to get to who should consider this. If you have a highly appreciated asset and you want to defer the payment of capital gains on the sale of that asset, this would be something good for you to consider. Now, last but not least, I want to talk a little bit about retirement planning. There's a lot of benefits in retirement planning. Unexpected things happen. The more prepared you are for that time of life, the less stressed out you'll be when that time comes. Proper planning for retirement can save you significant tax dollars. It can help you make better career and financial decisions to know that you are prepared for retirement. You don't have to worry about being a burden to others. That's one of the biggest concerns my clients express to me. And you can, through proper planning, you can continue your legacy through gifting. So on the next page, we are certainly not going to cover all of this, but there are a lot of retirement plans out there that you can consider. And I hope someone has already sat down with a chart like this with you to help you determine which type of plan is in your best interest. The one that we want to really talk about today is the cash balance plan, because I find that it is so often overlooked and not talked about. Even your CPAs don't typically bring this up. A cash balance plan can be combined with a 401k profit sharing plan, or it can be a standalone plan. You make tax deferred contributions into the plan. The amount that you can defer into this plan is much bigger than any other plan out there. In 2025, you could put as much as $341,000 into a cash balance plan. You do have protection from creditors, bankruptcy, and lawsuits. You can, at retirement, roll these funds into an IRA, and it works very well for sole proprietors, S Corps, and C Corps. One thing to keep in mind is that once you put a plan in place, contributions are non-elective. You have to contribute to it every year. It does require the work of an actuary, which makes this type of plan a little more expensive, and you need to keep the plan open at least 3 years to satisfy IRS that you really intended to have this plan in place. So who should consider a cash balance plan? Well, first of all, you want to make sure you have consistent cash flow and a pretty high profit margin, because as I mentioned, contributions have to be made every year. If you are an owner and you're in a high federal or state tax bracket, if you want a large tax deduction, if you are playing catch up and haven't saved for retirement the way you feel like you need to, all of those are excellent reasons for considering a cash balance plan. I want to quickly work through 2 or 3 examples to show you how this works. The first example here, we have a 35-year-old consultant with $200,000 a year in W-2 compensation, $150,000 in profit coming from his business for total income of $350,000. Now, if he only has a 401k, he can only defer $23,500 to his plan. And his 401k has a profit sharing that gives him another $12,000. If he added on a cash balance plan, that would give him another $92,000 a year that he could put into this plan. The tax savings on that cash balance at a 40% tax bracket, considering federal and state taxes, is about almost $37,000 a year. Now let's look at this second example of a 58-year-old physician. Same W-2 compensation, more profit coming through from the business, so more total income. Because they're 58, they can contribute more to the 401k, so they're putting in $31,000. They also have a profit sharing coming from the 401k. In this situation, she can contribute $200,000 to her cash balance plan. So you can contribute up to your W-2 compensation to the $341,000 2025 limit. In this situation, that cash balance contribution saved her about $80,000 in taxes in that 1 year. Now, because of cash balance, the amount that you can contribute is based on your income and your age. This is very beneficial for owners who have maybe waited too late to start their retirement planning. I also want to show you this last example because a lot of folks shy away from cash balance because they may have to make a contribution to employees that they don't want to have to contribute to. So I want to give you a quick example of an owner that has 2 children working in a business with them and 2 non-highly compensated non-family members. And just quickly, I want to demonstrate that in this situation, the owner maxed out what they could contribute. They did have to contribute a small amount for the 2 family members because they are family members and highly compensated, but had to contribute nothing for the 2 non-family members in the company. So in this particular example, 80%, if we forward, 80% of everything that the owner put in went into their own pocket. 97% of everything the owner put in went to family members, the owner and the family members. In this situation, the owner saved over $90,000 in taxes, and the annual cost to administer on this plan was probably about $5,000, would be a fair estimate. Last slide, I just want to mention that, of course, the reconciliation bill was passed a week or so ago. There are some provisions in there that you may want to sit down with your CPA and discuss. There are included in that bill greater benefits for pass-through owners. More service businesses qualify for that pass-through. State and local tax deduction was increased from $10,000 to $40,000. It permanently increased the standard deduction for everyone. There's a bonus deduction for seniors of $6,000 per person. And it gives us a little more certainty around future tax rates so that we can do better tax planning for our clients. So just a few points to ponder. Do you have liquid assets that are adequate? Are your personal finances on the back burner as you grow and operate your business? Are you maximizing all of your tax deferral opportunities? Are you prepared, or will you be prepared for retirement when the time comes? Have you considered tax efficient strategies for exiting your business, such as 1031 exchanges and deferred sales trust, gifting shares of ownership in your business to family members? And are you working with a professional team? So I hope I've left a few minutes here for some questions.
I have a few. We got a couple of good questions here. Thank you, Melissa.
It was a
lot for you to.
It's a lot.
I
Just
learned
try to get those creative juices flowing and get you thinking about a few things.
So, for me, it's super helpful just to learn the concepts and know what we're talking about if I hear those terminology again. So we're going to tackle some questions. If you guys have additional ones, just pop them in the Q&A. We'll go through as many as we can. So Melissa, this first question goes back to our conversation about operating cash in the company. And the question is, if you're an S corp and you keep significant cash in your corporation, how do you protect your corporation from a possible lawsuit? So the question is there a safe way to save money without exposing yourself? And I guess the assumption is that if there's a lawsuit and you have a good bit of cash there, then the cash might be vulnerable to a judgment on that lawsuit. Any thoughts on that?
I mean, I guess that could be the case. But I feel that the protection that it gives you from having that operating cash available, to me, offsets the risk of exposure. Now, we do have some clients that move funds out into investment accounts that they know that they can readily access when needed. So that could be another thought. But again, I think just knowing that you have the liquidity and the ability to access in difficult times is, and that right number is going to be different for everybody depending on your type of business, whether it's cyclical or, those sorts of things as well. So a lot of things will go into that decision.
Sure. Yeah, I mean, my first thought would be that typically your insurance company would be the ones to pay the cash out if there were a judgment against you. I haven't heard of anyone having issue with cash in the organization, but also a great question for your attorney.
Yeah, and also, just to have someone look at that insurance, that underlying insurance, do an analysis, make sure you've got the right kinds and the right amounts. And I know insurance has been a difficult topic, especially in this industry, in recent years. So that makes it tough right now.
I was about to say the I word. We might not go there as a tough one. We have a speaker at Shift who I'm excited about, shares information about very proactive actions a business owner can take before they have an issue with their insurance. It's basically controlling your narrative with your insurance company. But this is a tough one. This is tough across a lot of industries. Yeah. And then we have a couple of questions on 1031 exchanges. So is there a way to make a 1031 exchange work for the purchase of new land and building a preschool as a ground up project? I know the short answer to that is yes, but you tell us the deets on that.
Well, I mean, as long as you have identified that new property and you can demonstrate that you are going to reinvest all the proceeds from the sale of the previous property into that property, it should qualify for that 1031 exchange. Don't ever take receipt of the proceeds from the sale of the first property. Make sure that intermediary keeps those funds. But as long as you can demonstrate that you are reinvesting in a like-kind property, it should be fine.
Melissa, do any timelines come into play there? Are there certain amounts of time, or are those different from construction?
I am not aware if they are different from construction. Yeah.
Okay. Yeah, well, I know it's possible. We have clients who have done it. Great question too. That
Mhm.
very often we have actually done this with clients where we've sold an existing performing piece of property because you can get a much better price for that,
Mhm.
and taken that money and swapped it into either a new acquisition or a new build. So
Mm.
yeah, we've done that quite frequently. Also related to 1031 exchanges, is there a smart way to get some cash out when you do a 1031 exchange so you do not have to invest everything back in? What do we need to
Well,
do about that?
I mean, if you do not reinvest everything back in, you will be taxed on the amount that you did not reinvest. So you can, receive boot, is, what we call it, above and beyond what you reinvest. It won't derail the entire transaction, though. You'd just be subject to tax on that portion that you did not reinvest,
Right.
as long as all the
Yeah.
other requirements are met.
I guess it depends on your definition of a smart way. I mean, what are you going to do with that money, right? I mean, you will have to pay taxes on it, but yeah, really good question there too. Any more questions, guys? Those were really good ones.
Yeah.
I learned some things about DSTs from you today. I thought that was really interesting and not a concept that we hear very often as small business owners. So that was quite interesting. Really appreciated that. More and more people using 1031 exchanges now. They are a lot of work. It's kind of like I say to our clients when they operate the food program. A lot of administrative work, but do it. Completely worth it. Even if you hire someone else to do every bit of it, it still saves you money.
It's so inexpensive when you compare it to the amount of tax that you can save, and just put that money right back to work the way you want it to be put to work. And I think the first time you do it is maybe a little scary, but once you see how it works and that it in fact does work, people usually kind of get over that fear.
One more, well, no, two more now. So over in our chat, we have a great question. My understanding is that most school structures are set up as pass-throughs, so pass-through entities. Are there enough advantages to the QSBS program now to look at C Corps?
That is a good question. And I honestly do not feel qualified to answer that, because I think that there's so many things that go into making that decision. And those things are so particular to your situation. I don't think I could really make a blanket answer on that, but I do think that with the passage of the Reconciliation Act, that is a conversation that would be good to be had with your CPA and attorney.
Right. Yeah. Going to be very specific to your individual situation. Back over to Amanda. Sorry if I missed the answer to this. You can ask anything you want, Amanda. But is Melissa available for consult on tax, financial strategy, and planning, or is there someone you recommend? I imagine you could support with that, Melissa. How can people get in touch with you?
Yeah, so all my contact information is here on this last slide. mbane@greenwoodcapital.com. My phone number, my direct line is 864-941-4066. I'd love to connect and help you any way I can, or direct you to someone who can if I can't. But yeah, welcome an opportunity.
That's the best question I've seen yet, Amanda. You will not be sorry. I'm telling you. I don't know. I mean, I've never quite had a resource quite as valuable as this, both friend and advisor. So I think that you would enjoy getting to know Melissa. Thanks so much for joining us, friends. Thank you for that great information, Melissa. Just so appreciate your time in helping our community navigate where they're headed with their growth, where they're headed with their exit in a way that helps them, because it's significant. The strategies you can put in place are very significant. They're not just nice. They make a huge difference. So thank you for sharing that with us.
Thank you. I appreciate the opportunity. Hope everybody has a great afternoon.
You guys take care, and we'll see you soon.